In the past, full employment has typically been followed shortly by a downturn. But the more recent recessions were caused by a collapse of asset bubbles, fueled by unprecedented dislocations and structural changes in the economy. A look back at past downturns shows just how unremarkable the current business cycle is, which could ultimately make it more durable. In 1990, a collapsing thrift bubble sparked a mild recession. The deregulation of consumer finance had led to a lot of bad debt, and a combination of tightening lending standards and widespread speculative losses pushed the economy into contraction. A decade later, the dot-com boom was creating unprecedented wealth, at least on paper. At the cycle's peak, the stock market's valuation had reached double the historical norm. If today's market were equally inflated, the Dow would be topping 50,000. Y2K kept the bubble going for a while longer. To keep their systems from crashing when the calendar turned over, businesses were forced to make huge capital investments in equipment and programming fixes. But as January 1st came and went, that spending boom evaporated. The bubble in tech stocks burst, erasing trillions of dollars of equity wealth and sending the economy into a mild recession. The housing bubble of 2007 through 2008 was far worse. A global savings glut allowed unprecedented volume of capital to flow into the American real estate market. When the bubble collapsed in 2008, the financial crisis affected the entire globe. These past bubbles were all unprecedented. The deregulation of thrifts, the rise of the internet, and the boom in global securitization were all new developments, each catching investors off guard. Markets failed to fully price in their risks, setting the stage for sudden downturns when the bubbles began to deflate. Today, things look different. Growth has been well balanced, not dependent on any single sector. Low unemployment and mild inflation are not by themselves destabilizing. The business cycle doesn't run on a timer. There would have to be a trigger to cause a new recession, and a major imbalance has yet to emerge.